Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome to Traders Corner, our real money weekly trading show, and as always we're joined by Garth McKenzie, who is of course the founder and editor of Traders Corner. Garth, welcome.
Hi Julieta.
Garth, we spent a lot of time last week talking relative, so looking at the relative sectors of the market, resources versus financials versus industrials, and you did say then that you might consider doing a pairs trade, and you are going to do one today for us, so perhaps we should just kick off with a reminder of why you want to have a look, want to trade really the sectors versus trade the sectors off against one another.
Yes, okay, well that's right. Basically, we've been in a period of transition in our market now over the last month or two, where we're seeing the sector leadership in the market starting to shift, it would appear, certainly from looking at these graphs. You know, previously it's been all about the industrial sector for our market, and that's been the main leading sector of the market, and that's where you wanted to be long. But now it does appear as if that relationship might be starting to break, and we are starting to see early evidence of the possibility that resources shares are now starting to take the leadership role on the JSE. So what I've got here again this week is basically building on what we discussed last week, is looking at the resources sector of the market versus some of the other sectors of the market. And that will then sketch the background for the trade that we've done today, which is a pairs trade, basically taking advantage of this newfound leadership in the market as I see it.
In fact, we normally talk about pairs trades in the context of one single stock against the other, so this is quite interesting today. It's something new for the portfolio, but let me not jump the gun there. So I know you want to look at the resources versus the all share and versus the other sectors.
Yes, well this is the first chart. So now this is looking at the resources index relative to the all share index. And what's quite interesting to note here is that we've had this downtrend. I mean, that downtrend does go back further, and I could have drawn this in differently, but I think that's quite relevant, that downtrend that I've joined there, or that joins a number of significant high points. And you can see that we've actually broken out through the top of that downtrend, and we've also broken another area of lateral resistance now. And for the first time now in a very long time, we're actually starting to make a higher high on this relative chart. And just to explain to the viewers what this chart is, you know, maybe I should have said this beforehand, but what it is it's a chart of the resources index relative to the all share index. So to calculate this graph, or to derive this graph, you take the historical values of the resources index looking back, and you take the corresponding values of the all share index looking back, and you divide them by each other. So the base index here is effectively the resources index. And what this means is that the fact that we've got this steady downtrend, what has been a steady downtrend, has implied that the resources sector has been underperforming the market on a relative basis. But now what's quite interesting to note is that we've got this large bottoming pattern over here on this chart. And we're starting to now see the first signs of break of that downtrend and some higher highs being put in. So what this suggests to me is that maybe we've seen the bottom of this underperformance for the resources sector, and we're now starting to see a new era where potentially the resources may start to outperform. So that's really sketching the background here.
Of course, it may look starker when you compare resources to industrials and then against financials. Yes,
well, let's do that. So now this is a chart of the resources index relative to the industrial index. Now this one goes back quite a lot further. It goes back to 2008, which basically was when we saw the resources stocks end their previous period of outperformance and begin a new period of underperformance, which has lasted 5 years. But if you look at that downtrend that I've drawn in over there now, notice that we are starting to break that downtrend again. And if I'll zoom in on that area now, so that's now the last sort of year or so where I've put that box around the trading action. I'm going to now zoom in on that area. That's what we've got there now.
Okay.
Again, resources, looking at resources against industrials. And what's quite evident here is, again, we've made a very big saucer bottom over here. We've now broken through this area of overhead resistance on the relative chart. We've broken out, we've come back, and we're now starting to test that. What was resistance would now theoretically act as support on a pullback. So what this is implying is that this could potentially be a good area to now start looking at buying resources relative to industrials, all right, if we look at this chart. And that's effectively what we're going to be doing with this week's trade.
And just quickly against financials?
Yeah, so against financials, a similar looking story once again. We've got this downtrend that has been broken, also a higher high. Okay. So if you look, once again, we've got this large saucer bottom type pattern that's been happening over the last year or so, and we've got a first higher high on this chart, which again implies that we're probably now starting to see the resources sector outperform the financials.
Okay, so this sets the scene. And Garth, you said you have entered into a pairs trade, but it's against one sector pitted against the other, which is quite unusual. So talk us through what you've done here.
Yeah, okay. Well, first of all, what a pairs trade is it's a trade where you simultaneously go long and short of two different instruments. Usually it's two different instruments. In this case, we're doing three different instruments. But the point is that you pair them off against each other. And all you're doing by creating this pairs trade is you're taking a view that the one part of the trade will outperform the other part of the trade. All right. And in this case, what we're doing is with the background that I've just sketched, looking at the strength of the resources sector and the relative weakness in the other two sectors. What I'm using to effect this trade is the Satrix Resi, which I'm going long of, and then I'm going short of the Satrix Indi, right, the industrial index, and short of the Satrix Fini. Now, those are exchange-traded funds which represent or mimic the indices that they track. All right. So what I've done here is I've gone long of the Satrix Resi in the amount of 200,000 Rand notional value. Then against that, I've gone short of a Satrix Indi with the notional value of 100,000 Rand, and I've also gone short of a Satrix Fini with a notional value of 100,000 Rand. So effectively, I've got a short position of 200,000 Rand, which is made up half of industrials, half of financials, and then I've got a long of 200,000 Rand, which is made up completely of the resources sector. And that's the way at the bottom there, those are the effective trades that I've done, and the quantity of each of these. I have done these via CFDs because there are CFDs listed on the Satrix products on the IG Markets platform, all right, which was what we trade on. So there the prices are. I've bought the Satrix Resi at 56 Rand 20, I've shorted the Satrix Indi at 54 Rand, and I've shorted the Satrix financials at 12 Rand 80. And you can see the notional values there in brackets. Basically, you can see it more or less offsets each other almost exactly to the Rand.
And the actual cost of the trade ultimately? Well,
the cost would be, the cost is that I would have to pay my transaction costs on each of these legs.
Yeah.
So I'd have to pay the standard IG Markets commission, which is 0.2% notional value on each of these legs. So it would be 0.2 on 200,000 Rand, right, which is a notional, which is 400 Rand plus 400 Rand on the other side. So my costs are around about 800 Rand to do this. Now, in terms of a stop loss, because this is always a difficult thing, people battle to get their head around how to set a stop loss on a pairs trade, because you're not looking at one instrument where you can just say, if it gets to that price, that's my stop loss and I'm out. You're now looking at a relative of different instruments against one another, which does complicate the matter to some extent. So what I've done is I've said, look, if this trade moves against me to the tune of 6,000 Rand or more, then I'm going to cut it, which is effectively, it works out at minus 2.1% of our portfolio value at the moment as things stand.
Okay, and 2% for those who maybe have forgotten is pretty much the maximum risk that you're prepared to take at any one points on any one trade within the portfolio.
Correct, and that's exactly what I've done here. I've gone for 2.1%. It's slightly bigger than our maximum normally, but the point is that the risk has been defined up front.
Okay, so Garth, you're going to have to flesh that out in a bit greater detail, how you actually set a stop loss. So you've decided on that level of 2.1%. Then how do you implement it?
Well, what you have to do then is actually monitor the performance of these stocks against each other and keep a running total of how your profit and loss is looking at any given time. And the difficulty here is that what I'm expecting the resources index to outperform the financials and industrials. All right. But you can potentially lose on one or two of these legs and still make money on the trade overall. The reason being, I'm purely looking for an outperformance of the resources. So if the whole market was to keep on rising, my expectation is that the resources would rise at a faster rate than what the industrials and financials would rise. There's a very real possibility that in that scenario, I will lose money on the industrial and financial legs of the trade, but I should therefore make more correspondingly on the resources leg of the trade, resulting in an overall profit for this pairs trade.
Okay.
And that's the important thing to remember, that you're not necessarily going to make a profit on each one of these legs. You very likely are going to lose money on one of the legs, but you need to make correspondingly more on the winning leg.
Okay, all right. Now that suggests then how big do the legs need to be stacked up one against the other? I mean, are they of equal size? So basically, having gone long of a Satrix Resi to the tune of 200,000 and shorted to the tune of effectively 200,000 on the Indi and Fini, have you balanced them out one against the other?
Yes, well that's it. You can see in terms of the notional values that I've put over here in brackets for each of those legs of the trades that I've done, they do offset. So we're long of 200,000 Rand and we're short of 200,000 Rand. And that's very important, because when you enter a pairs trade, you're purely looking for an outperformance of the one area against the other. So you must pair them off in equal notional value. Otherwise, you'll have a lopsided trade.
Three-legged trade, possibly.
Yeah, well, this is a three-legged trade. But the point is that the long side of the trade and the short side of the trade do offset each other perfectly. Okay. And what I'm doing, what I effectively achieve there, is purely looking for an outperformance by resources stocks relative to the others. And it is important that the legs must be equal in size.
Okay. Is there anything else as far as pair trades are concerned that one needs to bear in mind?
Well, here's some key points that I've put a list of 5 things together that you need to keep in mind whenever you're trading a pairs trade. So the first point is that you're playing a relative of one or more instrument against the others, and I think we've made that point fairly clear here. It's market neutral, all right, as the legs are of offsetting value. What that means is if we were to see the whole market rally aggressively, or alternatively if we were to see the whole market collapse all of a sudden, we are market neutral because we're long of 200,000 Rand and we're short of 200,000 Rand at the same time. So that makes us market neutral. We're purely looking for an outperformance of the one sector against the other. Number 3 is that your transaction costs are higher in a trade like this because there are more legs to a trade. And effectively, I mean, in doing this, we've had to go long of the Resi, short of the Indi, short of the Fini, and we've paid transaction costs on each of those. There's 3 legs to that trade.
And then you have to exit them as well.
Correct. When we go out of this trade once again, I'm going to have to pay transaction costs on each of those 3 legs once again. So it does become a fairly expensive way to trade. And you do need to have a fairly high conviction that the trade that you've done is likely to work in a reasonably significant way.
Okay.
All right. And then the 4th point is that you're looking for the outperformance of one side of the trade against the other. I think we've discussed that. And the last thing is that also what I've mentioned is that it is possible to lose on one leg of this trade and still make a profit on the overall trade.
Okay, so we have done this before, and I recall that we kind of ended up in a fairly neutral position at the end of the trade because we had lost out on one and maybe didn't win, if one can put it that way, to the extent that we had wanted on the leg I think that you had gotten long of. But let's hope.
Yeah, let's see how we go here. You know, I think what the probably worst case scenario here is that the market, well, those relative charts that I've shown you just continue to dribble along sideways.
Yeah.
But based on the technicals that I've sketched there, I think there is potential for us to see continued outperformance by the resources sector. But if it doesn't work out, as with every trade, I mean, every time we go into a trade, there's risk, and we assume that risk up front, and we take cognizance of it. And we know that if we lose 6,000 Rand here, then that's it. We're done. We're out of this trade, and we'll put it down to school fees. But I think there's a reasonable chance that this will work for us. The question is just how long is it going to take for it to work?
Okay, guys, so we have to leave it there. What does the portfolio then look like? Is it pretty much stuck?
It's the same, yeah. So, I mean, it's been stuck at the same level over the last few weeks, which I think indicates that I have been sitting on the fence to some extent.
Yeah.
But we are up 15.5% for the year to date, and I think that's a good start, especially given that the markets have been rather turbulent and difficult, I thought, to read over the last few weeks. Preserving capital has been my number 1 priority, and I think we've done that successfully, but now we've put on a trade this week, and we'll continue to look for opportunities as and when we see them.
Yeah, okay. And then just very quickly, you had a face-to-face session last week, and you've got one this week too. Face-to-face
will be at the end of this month, and I'll put up details of that later in the month. But right now I've got an Understanding CFDs course this week, Thursday, in Johannesburg. That's the 6th of March. And then I've got high probability trading courses in Durban on the 8th of March. That's this coming Saturday. And then on the 20th 29th of March in Johannesburg. So anybody that would like to attend any of these, please email me, garth@traderscorner.co.za, and then I'll send you the details.
Okay, great. Garth, we'll leave it there. Thanks as always for joining us on the show. It's Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.